Imagine you're trying to map like a subterranean root system.
Okay.
You're standing in a forest and you're looking at all these individual trees above ground.
Right. And it seems completely obvious which tree is which.
Exactly. But then you start digging and you realize that maybe 50 yards away, underneath the soil, the roots of an oak are completely tangled with the roots of a maple.
Yeah, a tree you didn't even know you were connected to.
Right. You pull on a root over here and suddenly a tree shakes over there. And, well, that hidden underground network, that is exactly what it feels like to navigate the landscape of international tax compliance.
That is, honestly, that subterranean root analogy captures the reality perfectly.
Because you think you have a clear picture of what you own, right?
Exactly. Most taxpayers, and frankly, a lot of tax professionals, they operate under this assumption that corporate structures are strictly vertical and, visually obvious.
Like an org chart.
Yeah, they look at the organizational chart on the wall and assume that is the absolute limit of their exposure, but the Internal Revenue Code does not respect that wall chart.
It really doesn't. It digs right into those roots.
It digs deep. And the terrifying part is that a lot of taxpayers, they just don't realize they are tethered to these massive hidden compliance obligations until, they get a notice in the mail.
And by then, it's too late. The financial damage is already done.
Completely done.
Which is exactly why we are pulling out the shovels today for this deep dive into the absolute labyrinth of Form 5471.
It is a labyrinth, for sure.
Oh, 100%. So if you are doing business globally, if you are an investor in an overseas startup, or even if you just happen to own a piece of a foreign entity alongside other Americans, you are standing in this forest.
You're in it, whether you know it or not.
Right. So we are putting two of the heaviest hitters from the Form 5471 instructions under the microscope today. That's Category 4 and Category 5 filers.
The big ones.
The very big ones. And to be clear for everyone listening, we're pulling this directly from the official sources. We've got the IRS practice units detailing the monetary penalties, the incredibly intricate statutory frameworks of Section 958 regarding stock ownership.
Which is a beast of a section.
It really is. And of course, the official instructions for Form 5471, specifically the version revised in December 2025.
Right. And I think we need to tell the listener right up front, the stakes for understanding these specific categories, they just cannot be overstated.
Yeah, this isn't a parking ticket.
No, not at all. We aren't talking about a simple math error on your return where you owe an extra $100 and maybe some interest. Failing to file Form 5471 or, filing it incorrectly, it triggers severe mandatory monetary penalties.
Right. Let's hit them with the numbers.
Okay, so the baseline penalty under Section 6038 is $10,000.
10 grand.
10 grand per form per year. And it gets worse. If the IRS notifies you of the failure and you don't fix it within 90 days, they start tacking on continuation penalties.
Like late fees on steroids.
Exactly. It's $10,000 for every 30-day period after that, up to an additional $50,000.
So wait, you could be looking at $60,000 in penalties for a single missing form.
For a single foreign entity and a single tax year, yes.
Okay, just to put that into perspective for the listener. If you have, let's say, an organizational structure with 5 foreign subsidiaries.
You have a very common scenario.
Right, and you misunderstand your filing category, and you fail to file for 3 years. You aren't just facing a slap on the wrist. You are looking at a potential baseline penalty of $150,000.
And that's before the continuation penalties even kick in.
That's insane. But honestly, as painful as that immediate monetary sting is, it isn't even the scariest part of the IRS practice unit we reviewed.
No, it's not. The real nightmare hides in the statute of limitations.
Yes. Let's unpack this, because this blew my mind.
It's arguably the most punitive mechanism in the entire international tax regime. So, for a standard domestic tax return, the general rule is that the IRS has 3 years from the date you file to audit you.
Right. You file, you wait 3 years, and then you can breathe easy.
Exactly. Once that window closes, you're generally safe. But for international information returns, like Form 5471, that rule is fundamentally altered.
Altered how?
The statute of limitations simply does not begin to run until a substantially complete Form 5471 is filed.
Okay, let me stop you there. Because the phrasing substantially complete feels like a trapdoor.
Oh, it is.
So what if, I file my Form 1040 or my corporate return on time, and I even include the Form 5471, but my accountant misses a single obscure schedule that was required for Y specific category?
Yep.
Or what if I completely miss the fact that I need to file the form at all? Does the clock on the statute of limitations just never start ticking?
That is the grim reality. The clock never starts. If the form is missing entirely, or if it is filed but it lacks the requisite schedules to be considered substantially complete, the statute of limitations for assessing those Section 6038 penalties remains open indefinitely.
Indefinitely.
It is a forever open audit risk.
That is terrifying.
But it gets worse. Under certain circumstances, failing to file the single informational return doesn't just keep the statute open for the foreign penalties, it can actually keep your entire tax return open for adjustments related to those foreign entities.
So the IRS could theoretically come back, 12 years later.
Absolutely. 12 years later, assess a decade's worth of $10,000 penalties and adjust your broader tax posture based on that single omitted form.
A forever open audit window. It's like leaving the front door of your house wide open and just hoping the IRS never walks down your street.
That's exactly what it is.
So to close that door and actually start the clock, the very first step is figuring out if you are holding what I like to call the master key to a foreign corporation.
I like that. The master key.
Yeah. So let's look at the heavyweight division first. Category 4 filers.
Okay, Category 4. Conceptually, this is the broadest net the IRS casts in this specific area. And its primary objective is really just establishing visibility.
Right. They just want to know what's out there.
Precisely. So the instructions define a Category 4 filer as a U.S. person who had control of a foreign corporation for an uninterrupted period of at least 30 days.
30 days. Okay.
Right. During the annual accounting period of that foreign corporation.
I want to dissect the word control here. Because, in a normal business context, control means you get to make the operational decisions.
Sure.
It means you sit in the corner office, you hire the CEO, you dictate the strategy. But knowing how the tax code operates, I highly doubt they care about who gets the corner office.
They do not care about the corner office at all.
I figured.
Control is a strictly mathematical determination. Under the statute, you possess control if you own more than 50% of the total combined voting power of all classes of stock entitled to vote.
Okay, vote.
Or more than 50% of the total value of shares of all classes of stock.
Hold on. More than 50% of vote or value.
Exactly.
Or, that or is doing a massive amount of heavy lifting.
It changes everything.
Let's play that out for the listener.
Yeah.
Say I am a U.S. investor, and I provide a massive infusion of capital to let's say a tech startup in Berlin.
Okay, Berlin startup.
In exchange for my money, I take non-voting preferred shares that guarantee me a specific dividend. Now, those shares make up 60% of the company's total equity value.
But no vote.
Right. The founders keep all the voting shares. I have zero say in the board meetings. I can't hire. I can't fire. Are you telling me the IRS considers me in control for Category 4?
By the letter of the law, you are in absolute control.
Wow.
Because your shares represent more than 50% of the total value of the corporation, you are a Category 4 filer. Period.
That's crazy.
It is. But that means you are obligated to report their income statements, their balance sheets, their accumulated earnings and profits, all of their intercompany transactions.
Wait. Even if the German founders refuse to give me that financial data, because, I don't have voting rights. I can't force them to hand it over.
The IRS position is generally that if you hold that much economic value, you should have negotiated the information rights necessary to fulfill your U.S. tax obligations when you made the investment.
Oh, wow. So I couldn't get the paperwork isn't an excuse.
Lack of access to the information is rarely accepted as reasonable cause for failing to file.
Brutal.
And the complexity multiplies when we move beyond direct ownership and look at the chain of control. The IRS looks right through those nesting corporate structures we talked about earlier.
The corporate nesting dolls, yes. Let's explore the example the Form 5471 instructions provide on this, because it perfectly illustrates how control cascades downward.
It's a great example. So the instructions offer this stark 4-tier structure. You have Corporation A, which is a U.S. entity.
Okay, Corporation A, U.S.-based.
And A owns 51% of the voting stock in Corporation B.
Got it.
Corporation B owns 51% of Corporation C. Okay.
And Corporation C owns 51% of Corporation D.
Okay, let's do the actual math on the economic reality here. Because Corporation A owns 51% of B.
Right.
To figure out what A actually owns of C, you multiply 51% by 51%, which is roughly 26%.
Exactly.
And then to get down to the bottom doll, Corporation D, you multiply that 26% by 51%. So Corporation A has an indirect actual economic interest in Corporation D of just over 13%.
13%.
13% is a minority stake. by any standard in the business world.
Economically, yes, it is a deeply diluted 13% interest. But for Category 4 purposes, the IRS does not care about economic dilution.
They only look at the links in the chain.
They look at the unbroken chain of categorical control. So they ask, does A control B? Yes, 51%. Because A controls B, A is treated as controlling everything that B controls.
So A steps into B's shoes.
Exactly. Then does B control C? Yes. So A controls C. Does C control D? Yes. Therefore, Corporation A is deemed to control Corporation D. So even if Corporation A, let's say our parent company is in Chicago, has absolutely no day-to-day interaction with Corporation D, which might be a tiny logistics outpost in Singapore.
Right.
Corporation A is on the hook for a full Category 4 filing for Corporation D. The master key opens every single door down the hallway, regardless of how far away the room is.
That's exactly right. And this brings us back to the purpose of the statute. Section 6038 is fundamentally an information gathering mechanism.
The broad net.
Congress recognized that if U.S. persons have the power to direct a foreign entity's actions, even indirectly through a chain of controlled subsidiaries, the IRS needs a complete map of that ecosystem. They need it to police transfer pricing and prevent income shifting.
Okay, let's talk about the temporal requirement you mentioned in the definition earlier, because this is where the compliance trap really springs shut. You said an uninterrupted period of at least 30 days.
Yes, the 30-day rule.
This feels incredibly aggressive. Let's map this onto a real-world mergers and acquisitions scenario.
Let's do it.
Suppose a U.S. private equity firm decides to acquire a French manufacturing conglomerate. They close the deal and buy 100% of the stock on March 1st.
March 1st, full control.
Right. But 3 weeks in, they realize the environmental liabilities buried in the French subsidiary are catastrophic. They panic, they find a secondary buyer, and they completely divest and sell the French company on April 15th.
Okay.
Total hold time, 45 days. Do they have to file?
Because they held more than 50% of the vote or value for an uninterrupted period of at least 30 days during that foreign corporation's annual accounting period.
Which they did. It was 45 days.
Right. They are definitively a Category 4 filer. The length of the hold beyond 30 days is entirely irrelevant.
That is a compliance nightmare. Imagine the accounting resources required to translate a French company's local financials into U.S. GAAP, reconstruct a balance sheet, and calculate earnings and profits for a company you only own for 6 weeks.
And that you no longer have any relationship with.
Right. You probably don't even have access to their ERP systems anymore.
It is an astronomical burden. And it frequently catches M&A professionals completely off guard. They assume that if they don't own the asset at the end of the calendar year, it just washes out of the tax report.
Out of sight, out of mind.
Exactly. But Category 4 does not care about your long-term business strategy or your year-end posture. As you said earlier, it acts like a motion sensor.
A motion sensor.
If you cross the 50% threshold and stay in the room for 30 days, the alarm goes off and the reporting requirement is locked in for that entire tax year.
Wow. Okay, so that is the heavyweight division.
Yeah.
The broad net of Category 4. You own more than 50%, you have the master key, you are caught.
Right.
But what if you intentionally structure your investment to avoid that?
People try.
Let's say you are a domestic corporation and you take a significant but strictly non-controlling stake. You buy exactly 20% of a foreign joint venture.
Yeah.
You look around the table. There are a few other American investors, maybe a few foreign partners. You think to yourself, fantastic, I'm at 20%. I escaped the Category 4 net. No master key for me.
Well, you have successfully avoided Category 4.
But I'm guessing the tax code has another net waiting right beneath it.
It absolutely does. You are about to walk directly into Category 5, the networkers.
Let's pivot to Category 5. If Category 4 is about singular control in information gathering, what is the core philosophy driving Category 5?
If Category 4 is a wide net, Category 5 is a highly calibrated scalpel.
A scalpel. I like that.
It is deeply tied to the concept of the Controlled Foreign Corporation, or CFC. The instructions state that a Category 5 filer is a U.S. shareholder who owns stock in a CFC for an uninterrupted period of 30 days or more during the CFC's tax year.
Still got that 30-day rule.
And who owned that stock on the last day in that year on which it was a CFC.
Whoa, hold on. Let's compare the tape here. We just established that Category 4 acts like a motion sensor. It only required 30 days of control at any point in the year. Buy it, hold it for 45 days, sell it in April, you file.
Right.
But Category 5 suddenly introduces this highly specific requirement that you must own the stock on the last day of the year. Why the sudden shift in mechanics? Why does the calendar suddenly matter so much?
The shift in mechanics reveals a fundamental difference in legislative purpose. As we discussed, Category 4 operates under Section 6038. It just wants the map.
Right.
But Category 5 operates under an entirely different statutory regime. Section 951 and the broader anti-deferral rules known as Subpart F.
Ah, Subpart F. Let's give the listener some historical context on Subpart F, because it really helps explain the logic here.
Sure.
Prior to the 1960s, a U.S. company could set up a subsidiary in a zero-tax haven like Bermuda, park a bunch of patents there, and let the royalty income just pile up tax-free.
Right, and the foreign corporation.
And the U.S. wouldn't tax it until the Bermuda company paid a dividend back to the U.S. parent. They could defer the tax forever.
And the Kennedy administration decided that was an unacceptable erosion of the tax base. So Congress enacted Subpart F. The primary goal of Subpart F is to currently tax U.S. shareholders on certain types of highly mobile passive income earned by their foreign corporations.
Like what?
Things like dividends, interest, rents, and royalties. And it taxes them regardless of whether that cash is actually distributed.
So it creates phantom income.
Yeah.
The IRS says, we know you didn't actually receive a dividend check from your Bermuda company, but we are going to tax you right now as if you did.
Precisely. The IRS forces the U.S. shareholder to include their pro rata share of that foreign passive income on their current U.S. tax return.
Ouch.
But to allocate that phantom income mathematically, the IRS needs a definitive snapshot in time. They need to know exactly who is holding the bag at the end of the music. So the tax code dictates that Subpart F income is allocated to the specific U.S. shareholders who own the stock on the final day of the year that the foreign corporation was a CFC.
The music stops on December 31st, and whoever is holding the chair gets the tax bill.
Exactly. Therefore, the Category 5 informational filing requirement is tethered to that same specific day. If you don't hold the stock on that final day, you don't get the Subpart F income allocation.
And you don't have the Category 5 filing requirement.
Right. Even if you held it for 11 months of the year.
That distinction is incredibly clarifying. Category 4 is, did you drive the car this year? Show me the mileage. Category 5 is, who was holding the title on December 31st so we can send them the property tax bill.
That is a perfect way to conceptualize the difference.
So to figure out if we are holding that title, we need to understand the underlying math of a CFC. Let's break down the two-step process you outlined from the sources. How does a foreign company officially become a controlled foreign corporation?
Step 1 is identifying the U.S. shareholders. And we have to use a capital S here because it is a defined statutory term.
Capital S, U.S. shareholder.
Yes. For Category 5 purposes, a U.S. shareholder is a U.S. person who owns 10% or more of the total combined voting power or value of the foreign corporation.
Okay, so the minor retail investors, the people holding 2% or 5% of a foreign tech stock, they are completely excluded from this specific calculation. We are only isolating the 10% or more club.
Correct. We filter out the minor players. Once we have isolated the members of that 10% club, we move to step 2. We aggregate their ownership.
Add it all up.
If all of those 10% U.S. shareholders collectively own more than 50% of the vote or value of the foreign corporation on any single day of the tax year, that foreign entity is branded a controlled foreign corporation.
Let's run a stress test on this math because the client effects seem brutal. Suppose a foreign manufacturing company is owned by a syndicate of 11 completely unrelated American investors.
11 American.
Yeah. 10 of those Americans own exactly 9% each. That represents 90% total U.S. ownership of the foreign company.
Right.
The 11th American owns the remaining 10%. Is this foreign company a CFC?
It is not a CFC.
Wait, it is 100% owned by Americans, but it escaped CFC status.
Because of the order of operations in the statute, Step
Right.
1, identify the U.S. shareholders. Out of the 11 investors, only one meets the 10% threshold.
The guy with 10%.
Right. The other 10, the ones with 9%, are completely ignored. Step 2, aggregate the U.S. shareholders. We only have one, and they own 10%. 10% is not more than 50%.
Wow.
Therefore, despite total American ownership, the entity is not a CFC, and no one has a Category 5 filing obligation or Subpart F exposure.
That is wild. The power of staying at 9.9% is immense.
It really is.
But let's tweak the hypothetical. Let's say 6 Americans each own exactly 11% of the company. The rest of the stock is owned by foreign nationals.
The outcome completely flips. All 6 Americans meet the 10% threshold.
Right, because they have 11.
Yes. So we aggregate their ownership. 6 times 11% is 66%. 66 is greater than 50. Boom. The foreign entity is a CFC.
Just like that.
And assuming they hold that stock on the last day of the year, all 6 of those American investors are now Category 5 filers, staring down the barrel of Form 5471 schedules and potential phantom income inclusion.
And for decades, that was basically the game. You managed your direct ownership percentages, you made sure the math stayed under 50%, and you stayed out of Category 5.
That was the planning strategy, yes.
But our sources devote a massive amount of ink to the fact that things have changed dramatically. They detail how Revenue Procedure 2019-40 had to splinter Category 5 into 3 incredibly complex subcategories, 5A, 5B, and 5C. What happened to necessitate that splintering?
What happened was the Tax Cuts and Jobs Act of 2017, the TCJA.
The TCJA.
It brought sweeping changes to international tax, and one of the most disruptive was the repeal of Section 958, subsection B, paragraph 4.
Okay, we need to translate that code section into English.
Yeah.
What did that paragraph actually do before it was repealed?
Before 2017, Section 958, subsection B, paragraph 4 acted as a shield. It prevented the IRS from using downward attribution to turn a foreign subsidiary into a CFC simply because it shared a foreign parent with a U.S. subsidiary.
So it blocked them from looking down the chain.
It essentially said you cannot attribute ownership from a foreign person downwards to a U.S. person.
And why did Congress repeal that shield in 2017? What was the target?
The target was corporate inversions. Congress was furious about U.S. multinationals moving their headquarters overseas to dodge U.S. taxes while still maintaining massive U.S. operations.
Oh, right. Burger King, Medtronic, all those headlines.
Exactly. By repealing the shield, Congress allowed downward attribution. This meant the IRS could suddenly look at a foreign parent, attribute its ownership of foreign subsidiaries down to its U.S. subsidiaries, and pull all those foreign entities into the U.S. tax net as CFCs.
It sounds like they used a sledgehammer to kill a mosquito. They wanted to punish inverted multinationals, but by repealing that core principle of attribution, they fundamentally rewired the diagnostic landscape for everyone else.
The collateral damage was unprecedented. Thousands of foreign corporations that had no direct U.S. owners suddenly became CFCs overnight because of obscure structural relationships within their global corporate family trees. And this brings us to the subcategories you mentioned.
Let's lay them out.
Category 5A is the legacy filer, the traditional U.S. shareholder who owns stock directly in a traditional CFC, like our 6 Americans holding 11% each.
Simple enough.
Category 5B is what the IRS calls an unrelated Section 958, subsection A, U.S. shareholder. This is an American who owns actual stock directly in a CFC, but the entity is only a CFC because of downward attribution from a foreign entity they are not related to.
Getting us here.
And finally, the most notorious of all, Category 5C, the related constructive U.S. shareholder.
Sounds ominous.
This is a U.S. entity that does not own a single share of the foreign corporation directly. They only become a U.S. shareholder, and the entity only becomes a CFC via constructive downward attribution from a related foreign parent.
Related constructive U.S. shareholder. I mean, it sounds like legal gibberish until you see it applied.
Yeah.
Our sources, specifically the Form 5471 instructions, they provide an example of downward attribution that perfectly illustrates the insanity of the 5C category. I want us to walk the listener through this structure step by step because it is the ultimate hidden root in our subterranean forest.
Let's do it. The example in the instructions is a masterclass in unintended consequences. Let's build the corporate family tree. At the very top, we have FP, a foreign parent corporation based, let's say, in London.
Okay, FP in London, at the top.
FP owns 85% of the stock of FS, a foreign subsidiary located in France.
So far, this is entirely a European affair. London owns 85% of France. Nothing to do with the U.S. tax net.
Correct. Now let's introduce a minority investor, a domestic corporation in the United States. Let's say a tech firm in Silicon Valley owns the remaining 15% of FS, the French subsidiary.
Let's run the CFC math on the Silicon Valley firm. They're a U.S. person, they own 15%. That is over the 10% threshold, so they are officially a U.S. shareholder.
Capital S, yes.
But they only own 15% total. That is nowhere near the 50% required to make the French subsidiary a CFC. So under the old rules, they just hold their minority stake and go about their business.
Exactly. Under the pre-2017 rules, this was a complete non-issue. But now we introduce the final branch of the family tree. FP, our London parent, also wholly owns D, a separate domestic corporation operating a manufacturing plant in Ohio.
Okay, let's visualize this. The London parent has two distinct operations below it, an 85% stake in the French subsidiary and a 100% stake in the Ohio subsidiary. Ohio and France are sister companies. They have the same parent, but they don't own each other.
This is where the post-2017 downward attribution rules detonate. Under Section 318, the IRS looks at the Ohio subsidiary, D. The rules state that a U.S. entity constructively owns any stock that its foreign parent owns.
I need to make sure the listener's tracking this. The IRS treats the Ohio subsidiary as if it owns the exact same assets its London parent owns.
Yes. Because London owns 85% of France, the IRS dictates that Ohio constructively owns that 85% of France.
Even though Ohio doesn't have a single legal claim to the equity of the French company, they don't get the dividends, they don't have voting rights, they just happen to have the same corporate mother.
Economic reality is irrelevant to the attribution rules. Because Ohio constructively owns 85%, Ohio is now a U.S. shareholder. And because that 85% crosses the 50% threshold, the French subsidiary is instantly converted into a controlled foreign corporation.
Wow. The entire character of the French company changed just because its London parent decided to open a plant in Ohio. So how does this play out across our filing categories?
Let's look at the Silicon Valley firm first, U. They hold a direct 15% stake. Because the French entity is now a CFC, U is a Category 5A filer. They went from a quiet minority investor to having full CFC reporting obligations entirely because of the invisible Ohio sister company they have never met.
That is just rough luck for the Silicon Valley guys.
It is. And then we look at the Ohio company, D. They are a Category 5C filer. They own 0% directly. But because they constructively own what the London parent owns, they are pulled into the Category 5 reporting requirement.
So the Ohio plant have to file a massive international tax form to report the income, balance sheets, and operations of a French sister company they have absolutely zero legal relationship with.
Yes.
I used this analogy earlier when I was reviewing the notes, and it holds up perfectly. It is the corporate equivalent of a bizarre Thanksgiving dinner where the IRS forces you to report your siblings' finances. You have absolutely no legal right to see your brother's bank statements, but the government requires you to submit them under penalties of perjury.
The Thanksgiving dinner analogy is incredibly apt. The Ohio subsidiary is placed in an impossible legal paradox. They have a strict statutory obligation to report the financial data of the French company to the IRS, but they possess no legal authority whatsoever to compel the London parent or the French sister company to actually hand over that data.
They can't force them.
Right. The foreign parent might simply say, no, that's confidential European financial information. We aren't giving it to our Ohio plant.
But the IRS doesn't care if the London parent says no. The $10,000 penalty still lands on the Ohio plant.
Which is exactly why the IRS had to issue Revenue Procedure 2019-40. They recognized that 5B and 5C filers were completely trapped. So they created these subcategories to offer slightly reduced reporting burdens.
Okay, what kind of relief do they get?
If you check the 5C box, the IRS excuses you from filling out certain schedules, like Schedule 1, which is the summary of shareholders' income, because they acknowledge you aren't actually receiving any economic income from the phantom shares.
Well, it's a small mercy. You don't have to fill out every single page of the form, but you still have to file it. And if the Ohio plant doesn't realize they have a French sister company, which is highly likely, and they fail to file the Category 5C form, the statute of limitations on their entire domestic tax return could potentially stay open forever. Ignorance of your corporate sibling's existence is not a valid defense.
That is the crucial takeaway. The compliance burden rests entirely on the U.S. entity to investigate its own global family tree.
This seamlessly brings us to the Venn diagram of Form 5471. We've looked at the broad net of Category 4 control. We've looked at the surgical subpart F-driven logic of Category 5 and the absolute nightmare of 5C downward attribution. But in the real world, these aren't isolated buckets. Sometimes you're forced to sit at multiple tables simultaneously.
All the time.
What happens when a taxpayer triggers both Category 4 and Category 5?
It is arguably the most common scenario for U.S. multinationals. A taxpayer can easily embody both categories for the exact same foreign corporation in the same tax year.
Let's build a clean, simple structure to illustrate this double trigger.
The classic structure. A parent corporation based in New York owns 100% of a manufacturing subsidiary in Mexico for the entire calendar year.
Okay, let's run the diagnostic. Does New York own more than 50% of the vote or value for at least 30 days? Yes, they own 100% all year. That triggers Category 4. Now for Category 5. Are they U.S. shareholder? Yes, 100% is over 10%. Is the Mexican subsidiary a CFC? Yes, 100% U.S. ownership is over the 50% threshold. Did New York own it on the last day of the year? Yes. So they trigger Category 5 as well. They are caught in both nets.
Exactly. They check both statutory boxes.
So mechanically, how does a tax director handle this? Are they instructing their accounting firm to generate two completely separate, redundant Form 5471s for the exact same Mexican subsidiary? Are they paying double the compliance fees?
Thankfully, no. The IRS instructions provide a mechanism to consolidate the reporting. On page 1 of Form 5471, there is a section called Item D, which lists the filing categories. The U.S. parent simply checks the box for Category 4 and the box for Category 5A on the same form.
That seems logical. But checking the box is the easy part. The actual heavy lifting of Form 5471 is in the schedules. Schedule C for the income statement, Schedule F for the balance sheet, Schedule M for intercompany transactions. Category 4 demands maximum disclosure. Category 5 demands highly specific Subpart F calculations. How do you resolve the conflict when the categories demand different schedules?
The Form 5471 instructions include a massive, somewhat intimidating matrix formerly known as the Filing Requirements for Categories of Filers chart.
I've seen it. It's a wall of text.
It lists every category across the top and every possible schedule down the side. The overarching rule is that you must meet the most extensive requirement.
So it's a hierarchy. Category 4 is essentially the apex predator of the filing categories. If Category 4 demands you file the balance sheet, but Category 5 doesn't, you're filing the balance sheet because Category 4 overrules.
Precisely. Category 4 forces the widest aperture of disclosure, but you still have to satisfy the specific demands of Category 5. For instance, the instructions explicitly state that you must provide Schedule All the summary of shareholders' income from foreign corporation and Schedule H1 for each person described in Category 4, 5A, or 5B.
Notice who is conspicuously absent from that mandate. Our old friend, Category 5C, the Ohio plant from our Thanksgiving dinner.
Right. And this goes back to the relief provided by Revenue Procedure 2019-40. Because the 5C filer is a phantom owner pulled in solely by downward attribution, they do not have an economic interest. They don't receive Subpart F income. Therefore, the IRS exempts them from Schedule 1.
Let's bring the Silicon Valley firm and the Ohio plant back for a logistical question.
Yeah.
You, the 15% owner in Silicon Valley, is a Category 5A filer. D, the Ohio plant, is a Category 5C filer for the exact same French subsidiary. Since they're both trapped reporting on the same foreign entity, can they just call each other up, pool their resources, and file one joint Form 5471 to save money?
It's a logical thought, but the instructions strictly prohibit it. Category 5B and 5C filers cannot file a joint Form 5471 with a Category 5A filer.
Why not? If it's the same French company, isn't the data the same?
Because their filing requirements dictated by that matrix are fundamentally asymmetrical. The Silicon Valley firm must file the income schedules because they are a 5A filer with an economic interest. The Ohio plant is exempt from those schedules. The IRS systems require that a joint return only be filed if the informational reporting requirements align perfectly. You cannot merge a 5A data set with a 5C data set on a single form.
So the IRS forces multiple domestic entities to file disjointed asymmetrical forms about the exact same foreign company. It's like essentially painting different parts of the same elephant from different angles. It's a staggering data collection exercise.
It is a massive burden.
But you mentioned earlier when we were reviewing the practice units that there are escape hatches. Let's talk about the exceptions that get you out of filing altogether.
The exceptions are critical, particularly for large corporate groups. The most utilized exception is the constructive ownership exception, detailed in Treasury Regulation 1.6038-2, paragraph J, subparagraph 2.
Okay, let's unpack how the constructive ownership exception actually functions in practice.
The core principle is preventing infinite vertical duplication. The regulation states that if you do not own a direct interest in the foreign corporation and your filing requirement is triggered solely because of constructive ownership through another U.S. person, you are excused from filing your own form.
Okay, that sounds promising.
But, and this is the absolute anchor of the exception, The U.S. person through whom you own the interest must actually file the Form 547-1 with all the required information.
Let's map this onto a standard private equity structure. I am an individual U.S. taxpayer. I own 100% of a U.S. holding company, an LLC taxed as a corporation. That U.S. holding company owns 100% of an operating subsidiary in Germany.
Okay, simple vertical chain.
Mathematically, the U.S. holding company controls the German sub. But through the chain of control, I, as the individual, also constructively controlled the German sub. Under the raw rules, we both have to file Category 4, right?
Under the raw statute, yes. Both the individual and the holding company check the Category 4 box.
But this exception steps in to save me. Because I don't own the German company directly, I only own it constructively through my U.S. holding company. As long as my holding company does its job, files the Form 5471, and attaches all the schedules, I don't have to attach a duplicate 5471 to my personal Form 1040.
That is exactly how it functions. It allows a multinational group to consolidate the reporting burden at the highest U.S. tier. The U.S. parent company does the heavy lifting, and the individual shareholders or upper-tier U.S. entities are sheltered by the exception.
Are there other exceptions that shelter taxpayers from bizarre attribution traps?
There is another highly specific exception designed to prevent absurd overreach. You are accepted from filing if your constructive ownership comes purely from a non-resident alien, assuming you have no direct or indirect interest yourself.
Give me a scenario for that.
Imagine you are a U.S. citizen living in Chicago. Your uncle is a citizen and resident of Spain, and he owns 100% of a Spanish hotel chain.
Okay, my Spanish uncle.
Right. Under certain strict family attribution rules, the IRS might theoretically attempt to attribute your Spanish uncle's ownership to you.
Just because we're related.
Exactly. The exception shuts that down. The IRS recognized that forcing a U.S. citizen to file a Category 4 or 5 return solely because their non-resident uncle owns a foreign business was an unenforceable and absurd burden.
Common sense prevails in at least one corner of the tax code.
Occasionally, yes.
But that momentary relief brings us to what I consider the absolute climax of this deep dive. As we look at how Category 4 and Category 5 interact and how these attribution rules function, we have to talk about Example 5. When you were pulling notes from the IRC 958 Rules Practice Unit, you circled Example 5 multiple times and called it a massive structural quirk in the law. Walk us into the strange case of the foreign joint venture.
Example 5 is where the labyrinth loops back on itself and the internal logic of the tax code fractures. Let's establish the players. We have a domestic entity, let's call them DPS, domestic parent sub.
DPS, a U.S. company, got it.
DPS constructively owns 90% of a foreign joint venture, or FJV. And crucially, DPS does not own this directly. They own it purely through downward attribution from a shared foreign parent, under the rules of Section 318, subsection A, paragraph 3, subparagraph cap A.
Stop right there. This is identical to our Thanksgiving dinner scenario. A U.S. company, DPS, constructively owning 90% of a foreign company, FJV, entirely because they share a foreign parent.
It is the exact same downward attribution mechanic, and we already know the result under Category 5. Because DPS constructively owns 90%, they cross the 50% threshold. The foreign joint venture is deemed a controlled foreign corporation. Therefore, DPS is a Category 5 filer and must report.
We've established that. The Subpart F rules pull them in. But what happens when DPS look at the Category 4 requirements? Category 4 is about control. They constructively own 90%. 90 is greater than 50. So logically, DPS should also check the Category 4 box, right? They are the master key holder, even if it's constructive.
Logic suggests yes, but the statute says no.
Wait.
Category 4 is governed by a completely different section of the code, Section 6038. And if you read Section 6038, subsection E, paragraph 2, subparagraph cap A, it contains an explicit carve-out. It strictly dictates that you cannot use downward attribution from a foreign person to a U.S. person to establish control for Category 4 purposes.
Wait, let me process the magnitude of this contradiction. The IRS looks at DPS, the U.S. company. Through the lens of Section 958, they say, we are applying downward attribution. You own 90% of this foreign entity, it is a CFC, and you are a Category 5 filer.
Right.
But then, the IRS looks at the exact same U.S. company and the exact same foreign entity through the lens of Section 6038, and they say, we forbid downward attribution. You do not control this entity. You are not a Category 4 filer.
That is the paradox in its purest form. The determination of whether you possess a controlling interest in a foreign asset fundamentally changes based entirely on which specific code section's glasses the IRS happens to be wearing.
It is Schrodinger's corporation.
Yeah.
You simultaneously control it and do not control it at the exact same time. The constructive ownership rules are weaponized to pull you into the Category 5 net, but a specific statutory blockade prevents those exact same rules from pulling you into the Category 4 net.
And this paradox perfectly illustrates why international tax compliance is not an exercise in generalized logic. You cannot apply a concept from one chapter of the tax code to another chapter and assume it holds true. The rules are deeply siloed. They operate on parallel tracks that occasionally collide and contradict each other if you aren't paying excruciating attention to the specific statutory cross-references.
I am genuinely staggered by that. A single taxpayer, a single foreign asset, two completely contradictory definitions of ownership. It is the perfect encapsulation of why pulling on one root in this subterranean forest shakes a tree 50 yards away. Let's pull back and try to synthesize this chaos for the listener.
Synthesis is essential because getting lost in the subparagraphs obscures the larger operational reality. If we step back, what is Form 5471 actually doing?
We've learned that it is essentially a dual-threat diagnostic tool. On one side, you have Category 4. It is the broad information gathering net. It is designed to catch anyone who possesses raw mathematical control over a foreign entity, even if that control only lasts for a fleeting 30-day window. It doesn't care about your economic intent, it just wants the map of your global footprint.
Correct. And on the other side, we have Category 5, which operates with the precision of a scalpel. It is surgically targeted at U.S. shareholders of controlled foreign corporations, specifically isolating who is holding the equity on the final day of a year. Its purpose is entirely different. It exists to allocate phantom subpart F income and generate current tax revenue for the Treasury.
We've seen how these two distinct tools overlap, forcing a single U.S. parent company to navigate complex hierarchical matrices to figure out which schedules to file without duplicating effort. And we've explored the absolute nightmare of post-2017 downward attribution, the 5C filer, where a domestic company is legally obligated to report on a foreign sister company they don't own, don't control, and can't legally demand information from.
But we also identified the crucial escape hatches. The constructive ownership exception allows a massive multi-tiered corporate group to breathe. By designating the top U.S. parent as the primary filer for the entire controlled CFC chain, the subsidiaries beneath them are shielded from duplicative paperwork.
Which brings up a very practical operational point. If you are a tax director or a CFO listening to this, and you rely on that top-tier U.S. parent to file the master form and protect the rest of the group, you better make sure that form is flawless. Because if the U.S. parent drops the ball, misses a schedule, or forgets a newly acquired subsidiary, the protection of the exception vanishes. And then all those lower-tier entities are suddenly exposed to the baseline $10,000 penalties, the continuation penalties, and the most terrifying consequence of all, the forever open statute of limitations.
Yeah.
You are no longer just managing a current tax liability, you're managing a perpetual compounding audit risk.
To manage that risk effectively, a multinational enterprise requires an almost perfect, continuously updated internal map of its global equity structure. It must account for real-time changes, acquisitions, dispositions, internal reorganizations, and even changes in the ownership percentages of your foreign joint venture partners, because their movements can alter your math.
Which leaves me with a final, somewhat philosophical thought to mull over. As we've dissected these practice units and instructions today, it is clear that ownership chains are becoming infinitely more complex and globalized. And in response, the IRS and Congress continue to aggressively expand these constructive and downward attribution rules to cast wider nets.
The expansion relies on the fiction of ownership.
It's exactly the legal fiction of ownership.
Yeah.
And it begs the question, will the statutory definition of control eventually become completely divorced from actual economic reality? We are rapidly approaching a paradigm where your tax reporting obligations are no longer dictated by what you physically own or what you actually have the power to direct in a boardroom. Your compliance burden is becoming purely a function of a mathematical matrix determining who you happen to be related to.
It is a profound shift in tax policy. When legal attribution rules override economic substance to this degree, international tax compliance ceases to be about tracking real dollars flowing across borders. It becomes an exercise in mapping theoretical, invisible connections.
And as we said at the start, when you step into the world of Form 5471, the expectation of precision or visual clarity is an illusion. You aren't just looking at the trees above ground. You are forced to dig into the dirt and diagnose a tangled root system that the tax code insists you're responsible for, even if you never planted the seed. Good luck out there in the forest.